Without further ado, we will turn the time over to Mr. Phua Lee Kirk, Chief Strategist of Phillip Research Sendirian Berhad, to update us on global market outlook. Let's welcome Mr. Phua.
If you look at the IMF forecast, of course, 2021 is a recovery year, and the forecast put that the emerging market, right, or developing countries, right, will have a sharper jump. But I think probably IMF may revise this down. The major reason is there is a so-called big gap between the developed country vaccination and also the development, the advanced economy, and then the emerging countries that probably give a very different growth rate as what IMF has forecasted. But all in all, actually, if I were to jump into conclusion first, actually it was our view since last year and also at the beginning of this year, it will be the developed countries that drive the economic recovery, then only followed by emerging countries. The signal or the indicator that's showing that actually developed countries, this is G7, okay? You look at the mobility, right? Mobility, I think you know, technically, so long as your handphone, you switch on your GPS, even without you switching on, actually they can trace where you are, and this is where they indication that people already start to move around, right? You can see it's gradually climbing. Of course, here you have the second, okay, depends on country, whether you call it second wave, third wave, it come down, now it start to back to normal again. And I think that this will be more sustainable because when we look at G7, I think the vaccination rate is quite all right at this moment. So what it means is that developed countries has already on its path of back to normal economic activity. And in fact, you look at it, it's very clear that vaccination is very important, right? You look at US, right? Total vaccination, the percentage per 100 people, so technically it's percentage. And this one is those who have fully vaccinated, that means 2 jabs for most of the vaccine, except for J&J vaccine, right? You can see that as vaccination gradually increase, essentially the daily new cases has been coming off all the while. And in fact, where you look at UK, it's the same thing, right? From the very back, which is more than 60,000 cases, all the way down to now is less than 1,000 cases. If your vaccination, right, like UK, close to 30-40%, right, where at least 1 jab is 90%, you can back to a normal life, right? The risk becomes much lower. So that's why developed countries, especially Western countries where the vaccination rate is very high, that's why they are the one that will lead the economy recovery. And if you look at the market, you can see it very clear, right? US market continue on this uptrend, although with some volatility. UK market also is improving. Sterling pound is also getting stronger. All this actually is a reflection of the containing the COVID and back to normal life. So when we take all these, like I say, we have never changed our view since actually last year. We look at the situation is that, of course, China and US will be the one that they can recover even higher than the 2019, the GDP, in terms of absolute term, right, above the 2019 level, then followed by EU and then Japan, because they are slightly behind in terms of vaccination. Then the rest of ASEAN countries, I think is still some way to go, right? I mean, to be above 2019 level this year is going to be very challenging. We still maintain the view that it will be in the year 2022. In terms of the so-called China-US or US-China, depends on what camp, which camp you are at, so-called trade dispute and all this, I think it's not going to be, it's not going to go off, right? Although initially there was a lot of hope that with Biden, things can be much better and all this, but it's not true because especially this year after the world experienced the semiconductor shortage. US, Japan, you know that they are relooked into the semiconductor supply chain. So which means that the trade relation is not going to improve with China, and especially with Taiwan there, not only trade relation, but also because of the political situation, geopolitical, right? Because currently Taiwan supply, right, 22% of the world semiconductor. What does that mean in terms of second half? Trade relation is not going to improve, but US is definitely, the economy is on the recovery, and it's technically, you look at the stock market, it is also very clear, right? You can see, like say, in February onwards, right, when it crossed the 8%, right, you can see that small business openings start to come back, right? And revenue for the small businesses also start to improve. And you can see that job posting, job openings for the service industry actually has spiked up, right? Has improved. Of course, air traveling also improving already. Now, the question is, when economy is recovering or actually is on track of growing, the worry is always on the inflation, right? Just now we mentioned that one of the factors is the pent-up demand plus the logistic cost, right? Will that drive inflation that force Federal Reserve to increase the rates and therefore cause the market to come down or prematurely kill the economy? At this moment, I think the risk is quite low, because you can look at it, the break-even inflation expectation essentially is still around 2.5, slightly above level for the 5 year. That means short term, they expect a little bit higher inflation because of the pent-up demand and partially of the logistic cost. But over a 10-year period, right, it looks like it's quite all right. It's quite all right. So, like I say, I agree with Federal Reserve that I don't think there will be a rate hike so soon. Essentially, I think now it's a little bit of a rotational, because you can see that looking at S&P, you can see that until now, right, value outperform growth or even Nasdaq. For the very simple reason is because when economy start to be back on track, life start to back to normal, service industry that was totally bashed down or badly affected by the COVID start to move back, then the investment focus will move towards to this type of sector for a while rather than on the tech stocks. That's why this year, on the second half, I would say that it's a GT race. I don't know who will be the winner. Of course, I hope Goldilocks is the best, right? I think the team will focus on Goldilocks, great rotation, green recovery. That's why you don't expect oil price to go to 100 or whatever, unless there's a geopolitical risk. Then later only start looking at GAFA, and another key is on the tapering. But our base case scenario at this moment, we think that inflationary pressure is a so-called short-term spike up, so it wouldn't be a bad factor to the market. The key we need to focus on is tapering, and it all depends on how the Federal Reserve talk about the tapering so-called speed. If the speed is gradual as what market anticipated, I think equity market will still outperform. With this, I will end my presentation. Thank you very much.
Okay, next, we are pleased to welcome Mr. Fong Wai Man and Puan Mutiara. Both of them are our fund managers managing Phillip Mutual's funds, and they will be providing an update on these funds that they are managing.
So, again, I would like to point out that with all this expectation of a faster economy pickup, actually one of the top priority of governments, not just in Malaysia, is actually to gradually phase out the stimulus packages, because as you can see, giving out free money is actually going to give a huge dent to the government coffers. And now, as we see it, Malaysia is already at a fiscal deficit, so is US, and a lot of other countries are actually facing a huge crunch in their cash flow, and they will make it one of their main priority to actually phase out the free money that they have been giving to the people. So this is another risk that we think we should highlight. So looking ahead into second half of 2021, I think we will straight away focus on the themes that we like for our funds. So what we are doing for our funds is that right now we are rotating into COVID-19 recovery sectors, because we think that some of the stocks has yet to recover to pre-pandemic level. Sectors that we think will tend to benefit, for example, is transport, energy and consumers, banks, especially REITs and construction. For banks, REITs and construction, especially these sectors previously has been bashed down uh, because of the pandemic, and most of these sectors have previously been oversold and are all now trading at steep valuations. Also sectors that we think we would moving forward focus on are the sectors that are poised to record further growth beyond the recovery phase. So these sectors are more towards the long-term trend. The long-term trend that most of the funds will be focusing on, such as the renewable energy, sustainability, ESG-based sector, and we also focus on technology sectors such as 5G, IoT, IT security, cloud, data storage, and automation. Also, another theme that I think we would like to focus on, and I think not many people actually talk about this team, is the Gen Z and the Millennials team. So Gen Z and the millennials are increasingly shaping the consumption in Asia and even globally. Gen Z and millennials have a very have a mindset that they want to live life to the fullest. So in that sense, the sectors that we think will benefit from this long-term trend is premiumization and online gaming, online transaction, e-commerce, and everything that make it everything that is convenient and is focused for the Gen Z and the millennials. Okay, the strategy for the funds moving forward, I think we would like to highlight that most of the funds right now, we are actively raising cash. We are taking profit on stocks which limited upside and which we think the stock has rallied beyond the fundamentals. Also, we have been trimming and switching out from underperforming counters and into counters with better prospect. So of course, these funds, some of them have some legacy names, which hasn't been performing. So what we have been doing is that we have been selling on strength, and we are slowly accumulating stocks and sectors that we think would perform and in the long term basis, such as the sectors that I have mentioned just now.
The government implemented the MCO 3.0, right? Because of the high number of COVID positive cases. As you can see in this chart, this is a number of cases versus the index, KLCI index. As the COVID cases start to come down, hopefully with more stringent lockdowns imposed by the government, there is a good chance that the local stock market could recover. So in my opinion, MCO doesn't just stand for movement control order, but in health terms, but in investment terms, it could also be an opportunity. It could be a money collection opportunity.
Our subsequent speaker is Puan Atifa from Phillip Capital Management. She will be updating us on PMART UT.
We usually try to diversify our portfolio across different asset classes, equity, bond, mixed asset, and also different geographical focus to Malaysia, Asia Pacific, and US. Next is in terms of the restriction. We do have restriction of 30% exposure in each fund house. From time to time, we review the fund performance. We review the fund performance on a monthly basis, and we rebalance as and when necessary, especially when there is a significant movement in the market. Next one, we usually maintain at least 3% cash for liquidity purposes, about 3 to 5% cash. I'd like to share with you some of the changes that we have made last quarter, in quarter 2. So basically, we have reduced our exposure in RHB Islamic global developed markets due to recent volatility in the US tech sector recently. And we have increased our exposure in Asia Pacific funds. Besides that, we also reduced our exposure in Eastspring Investment Dynasty equity and increased our exposure in Principal Greater China due to its performance. Principal Greater China has better performance as compared to Eastspring, and also lower exposure in tech sector as compared to ESG investment dynasty equity. So those are some of the changes that we have made last quarter. So in short, for the summary, we would advise the client to stay invested to take advantage of gradual economic recovery driven by extensive rollout of vaccine globally. And I usually advise the client to actually make regular contributions, because some of them might be wondering, is this the best time to invest? But we usually advise them to make regular contributions in order to increase their chances of investment success, to accumulate on dips during market downturn. So I think, this would be the best time for the investor to keep accumulating when the market is down. Yeah.
Okay, last but not least, I would like to welcome Ms. Tan Zini, Fund Manager from Phillip Capital Management. So Zini will be introducing two new income funds to us today, namely Phillip Wholesale Income Fund and Phillip Wholesale Islamic Income Fund.
Okay, on the 3rd of May, we have actually launched two new income funds. One is a conventional, another one is actually an Islamic income fund. So basically, a wholesale fund is to be actually eligible for a qualified investor, or we call it sophisticated investor. So the purpose of having this fund is to have regular incomes to our investor while actually maintaining the liquidities and for our clients. Before we actually allow the investor to invest, basically we would have a checklist for our investor or potential investor, so that we will need to have a checklist and to confirm that and make sure that they are a qualified investor before they are allowed to invest into this fund. So we might request some documents from your potential client if there's any, or else we will for those big corporates, basically we will just require the annual report will do. So of course, capital preserve is our main concern for all our investors. So this new fund, for these two new funds, basically they will have so-called fixed NAV for these two new income funds. And then of course, we will continue to maintain the liquidity where our investor can actually do their daily redemptions before 10:30. There is no access fee as well. We will try to look for investment on the MGS or GII for the Sharia compliance fund. But looking at the near term, we are not going. We are no hurry to invest into the fixed income securities, as our allocation is 0 to 100%. So for this fund, our target rate would be 1.8 to 2%.